Hello and welcome to the show. We call this Molotsky on Money. What's the show all about? The clues are in the title. We'll be discussing money, specifically investment strategies, taxes, estate planning, insurance, and many other topics, all of it designed to help you and your family improve your overall financial picture. The Molotsky part of our title comes from our panel. Their name is Molotsky. Each week we have Stan Molotsky, president and founder of the SHM Financial Group, as well as Lee Molotsky, vice president of the SHM Financial Group. We invite you to stay tuned because we have valuable information on this show and every show that we hope you and everyone can benefit from. And as part of our continuing, education information, Stan?
That's exactly what it is.
That's what we're going to do tonight. We continue the process here on the show. We're going to talk about helping people avoid mistakes. And unfortunately, in this day and age, because of technology and even media, which we're on, sometimes leads to people doing things that maybe they shouldn't do.
Well, you get caught up in the the fast pace of all of that, from the internet to the computerization to all the stuff that you see on television. Sometimes you do, get swept along with it, and you have to take a deep breath, stop, and go through some of the things we're going to talk about tonight, just to put yourself in the proper framework so that you can be successful in doing what you're doing.
Lee, I guess, unfortunately, a lot of times you see people come in to talk to you, and you probably shake your head like in the first 5 minutes because you could probably pick up a bunch of mistakes they've already made, correct?
Well, it's following the pack is really one of the biggest mistakes we see out there. What everybody else is doing, they assume everybody's doing it. It's the Brooklyn Bridge theory. If everybody's jumping off the Brooklyn Bridge, as a young kid, I was told, don't follow everybody else. If they jump off the Brooklyn Bridge, don't jump off the Brooklyn Bridge, just because everybody else is doing it.
I know somebody who might have said that to you.
Right. Lee never followed anybody
I would probably jumped off a different bridge.
Right. I guess that's a good thing. Right. But I'm going back to the technology heyday. You said to me, I remember this like it was yesterday. You said, this bubble is going to burst. And this was like everybody's buying tech stocks. Remember that? Everybody. And you said, this bubble is going to burst. And 6 months later, it burst. So again, that was following the herd.
Well, we want to stay a little. What's right in front of you, sometimes it's hard to often see. So we see certain things in our practice that on anticipation of what we see, we just give people a lot of we try and give as much advance warning as possible so that they can avoid that pitfall.
Certain things are blatantly obvious.
Yes.
When you have a period of time where for 40 years, interest rates, for example, have been gradually going down to where they hit basically zero, I think it's a pretty safe assumption that you could make that they will eventually turn around and go up.
Right.
Okay. Well, here we are at this point where they are looking like they have bottomed and they are gradually going to move back up. So therefore, as you look at where you are positioning yourself and where you are putting money, you have to take advantage of what will probably happen, which will be, over the next X number of years, a higher interest rate environment. Therefore, you have to start positioning your investments into those kinds of things that will make the most sense.
Okay.
I was going to say, one of the hardest and most difficult things in investing and being in the financial world is there's no warning signs. You're not driving down the road and saying, stop here. There's no exits. There's no entrances. Everybody can do whatever they want based upon their own personal situation. So there's no, there's unlimited mistakes that you can make. One of the biggest and most difficult things to predict is the interest rate environment. And we've seen I would almost not say gradual change in interest rates. We've seen a very, very expeditious movement in the 10-year Treasury, rates on the 10-year Treasury recently.
Okay, we're going to talk tonight about rules that SHM Financial suggests you follow in order to avoid potential investment mistakes. And as we said at the start of the show, unfortunately, there's a lot of things happening in the world today that can lead people to make mistakes. And we're going to get right into the first one here. And it's one that we've said on the show many times, and it's very basic, Stan. Ask questions.
You have to. No matter who you are, who you're dealing with, you have to ask a lot of questions, and you have to get answers that you can basically understand. And what we try and impress upon the people that we meet with, you ask the questions, and our job is to get you the answers. Obviously, we're not going to know all the answers, but we have outlets to get you the answers. And we have to, our job, Lee's, mine, and the people that work with us, our job is to explain the answers to the questions that people ask in a way that they understand it. And if they don't understand it, it's not their fault. It's our fault, or the people that are presenting the explanation. And you can't beat yourself up if you don't understand what they're saying. It's not your fault. And therefore, you should then move on and go to somebody who can explain it so that you can understand
All
it.
right, let me follow up that question with a question. When you say ask questions, and either one of you can answer this, how do you know what questions to ask?
Just the basic things that you want answered. Everybody wants questions answered based on their particular set of circumstances. Do they have enough money to retire? What are the kinds of things I should be putting my money into in today's economic environment and political environment? What are the health situations I have? Therefore, what are the kinds of things I should be looking towards? And how can I protect these assets? I want to pass these assets on, to my heirs, or I need the money, for now, and I want to make sure there's X amount of dollars so that I can live X number of years. All those things are the questions that people have in their mind. They just sometimes can't get it out, to ask.
Okay, so it's your job to ask it.
Correct.
So a good advisor should be asking
Oh,
those.
absolutely.
Okay.
And the other important thing for anybody watching this program, it's important that you're dealing with whoever you're dealing with, that they have an unlimited access to the different things that you need. In other words, they're not limited to a specific product line. They have the ability to do whatever it is you need to have done based on your particular set of circumstances. And the circumstances change. What you want done today when you're 50 is totally different than what you probably want to have done when you're 65, or then when you're 75 or 80. And all those things have to be tailor-made, so to speak, based on the particular goals and objectives and risk tolerance of the particular individual.
Lee, you wanted to add something to that?
I was going to say one of the biggest issues that we have when we meet, not we have, but when people come in, is that they don't necessarily understand money. A lot of people come in and say, I don't know what to do. So our job is to really be a detective and ask the pertinent questions so we understand what their goals and objectives are. If they don't know, then we say, well, I want you to kind of define your own goals and objectives. What is this money for? And how much risk, if any, are you comfortable in taking?
Okay, we're talking about rules that SHM Financial suggests you follow in order to avoid potential investment mistakes. And unfortunately, as we've been saying, there's a lot of pitfalls out there. Consider the source. And in preparing for the show tonight, I was looking at these and I'm saying, what is he talking about? What are you referring to? Consider the source. Consider if it's coming from an investment advisor or from a large company, or what do you mean by that, Stan?
Just exactly that.
Really?
Who's telling you whatever it is about that particular thing that you're talking about?
I got one. My brother-in-law said.
There you go, right.
My brother-in-law said that he never lost money in the stock market.
Well, those kinds of, right, no, that kind of.
That's the source you're talking about?
Exactly. Or even my father said, or my son said, or my daughter said, or my beautician said,
Yes.
or my barber said. I mean, then you say, okay, fine, well, then that's where it's coming from. Should you really base your life savings and goals and objectives on that particular source that you're referring to? That's the point we're trying to get across.
Okay. We have more to talk about here on the show. It's Molotsky on Money. We are here every week at this time discussing a variety of issues, of course, all of it financial in nature. And tonight we're talking about rules that SHM Financial suggests you follow in order to avoid potential investment mistakes. Yes, we have plenty more to talk about on the show. With Stan and Lee Molotsky, I'm your host, John DeMasi. More Molotsky on Money after these words. Stay right there.
Just as it's extremely important to have your automobile's brakes tested, we think you must have some type of safety net provisions in your financial plan. How are you protecting your bond positions from rising rates? How are you protecting your stock market gains from market sell-off? Do you have the proper provisions in your financial plan to assure that your income lasts as long as you do? Are you keeping up with inflation? Call 1-800-MONEY-SHM to schedule your safety net review. That's 1-800-MONEY-SHM. Not everyone can endure the ups and downs of the market. When planning for retirement, you can ride the roller coaster and take your chances, or you can eliminate the downs by properly repositioning most of your portfolio. If you're 5 years pre-retirement or 5 to 10 years into retirement, it's not too late. As a matter of fact, it's never too late to avoid the next down movement. Call the SHM Financial Group at 1-800-MONEY-SHM or check us out on the web at shmfinancial.com.
Welcome back to Molotsky on Money. Don't forget, if you would like to contact Stan or Lee Molotsky at the SHM Financial Group, during the course of the show, we put up their toll-free number, also their email address and their website. You can contact them any of those ways. And if you would like to sit down with Stan and Lee and go over your particular issues, situations, whatever it happens to be with you and your family, feel free to give them a call. They'll be happy to talk to you. And remember, the initial consultation is complimentary. And like I always say here on the show, if you tell them that we look great on TV, I think you give them a lollipop, Lee. Is that what happens? One of your leftover?
That would be your dentist.
Oh, your
Okay. We give him a 2013 calendar.
Okay, all right.
It's the end of the year.
All right.
Okay,
Well,
exactly.
we'll have to increase the prize closet, all right? We'll work on that. We'll let you know. We're talking tonight about potential mistakes, and SHM Financial would like you to follow these rules in order to avoid potential investment mistakes. Let's get right into it now. And this is a very interesting one. We could probably spend a whole show on this one. Trust yours and or your spouse's instincts. Both of you being long married gentlemen, you're both very well qualified to talk about this. So Stan, let's start with you.
Well, a lot of times we will meet with the husband or the wife, and then we'll say, before we do anything, it's critical, and we're not going to go further until we meet your spouse, because your spouse may have specific instincts or specific things that he or she would want to interject into this discussion, and we all want to be on the same page. So as part of our practice, we'll meet with whoever, and then, but before we finalize anything, and before we take them as a client and they take us as an advisory entity, we want to meet with the total package, so to speak. We want to meet with both before we go further. So.
And then once you meet with both, Lee, what happens then? I mean, where does the instincts come in, or where does the joint effort come into play, and then where does it go from there?
Well, I often say, if we were not here, sitting here at the table with you, tell us what happened. Talk to each other as though we were not here, and let us know how you feel about this discussion that we've had. Talk openly, because we're open and candid with you about what we're talking about. So tell us what you're looking for. I mean, it's really, you have to really be on the same page as both individuals, as a couple. And that's why it's important to have both parties there before they make a decision.
Well, it's an ongoing process, and a lot of times, we'll meet with people, and after they leave, I'll look at Lee, Lee will look at me, and I'll say, I think we can work with these people. And every once in a while, Lee will say to me, I don't know if we can work with them. And I think, and I'll say, I think you're right. And therefore, let's just say, we'll send them a letter saying we appreciate the time they spent with us, but we suggest you see another advisor, because we're just not on the same page.
Right.
So
You mean you guys actually agree once in a while?
we agree most of the time, which is pretty neat.
Okay. We're talking about rules that SHM Financial suggests you follow in order to avoid potential investment mistakes. And let's go to our next one. And this one has been talked about. We've talked about this on the radio. We've talked about it here on TV. Don't chase past performance. I love the story every year, and you've told me this before. Money Magazine, or one of these magazines, comes out with the top 10, plug in the year, top 10 investments of 2013. And then you look, and then 6 months later, they're in the bottom. So that's chasing past performance, correct?
That's correct.
Right.
Okay. So don't do that.
No.
Well, you get
Don't buy Money Magazine and make investments based on that.
Well,
based on
you
that,
can
right?
buy the Money Magazine has some interesting articles, give you some certain philosophical things, but they're talking about things that have happened in the past. It's like, ball teams, basketball, baseball, hockey teams. I mean, you're not, looking to follow the team based on what they did the last 3-4 years. You want to see what they're going to do for the next year, 2 or 3. And it's the same thing when you're obviously investing. You want something where the prospects are positive going forward, forget what they were going back. So the idea is to look at the different things that you're trying to accomplish with the particular investments. Whether you're investing with a management in a mutual fund or an ETF, you want the consistency of that performance, not necessarily what they did in that previous 3 months, 6 months, 12 months.
It's kind of like you compared it to sports, but it's kind of like saying, okay, our team has this, but let's look at what we have in our minor league system, or let's look at the college players that we're going to pick up.
Exactly.
And then we're going to be good based on that.
Right.
So you kind of have to look at that with investments,
Of
right?
course, absolutely.
They hired a new manager
Right.
or something.
It's-
Those are the indicators, basically?
Well, when you look at, say, mutual funds, what you're doing, you're basically buying the management of that particular group of holdings. So you're investing with management. So our goal, our key, is to look at the manager and managers of that particular mutual fund to see what their performance has been and the consistency of that performance. And when that manager leaves, then therefore we have to make a judgment based on that particular mutual fund. Do you stay with it or do you follow the manager? And sometimes you leave it and you follow the manager.
And again, not what they did before, but what they're going to do
Exactly.
moving forward. Lee?
Exactly.
From a sports standpoint, the manager is really the players. So in a mutual fund, in the mutual fund world, the manager is the manager or managers are the ones responsible for running or managing the monies. It's as though the baseball team has shifted players. The 3 core players got traded from one team to another. If that happened, you'd probably follow the players because that was the core of the team. So if the manager moves, we often shift gears, as you say, and move monies from one fund to another to follow the management.
See, in the sports analogy, it may not be quite accurate in the sense the manager of the team does not necessarily be the general manager who is getting the players.
Right.
The manager of a mutual fund is the one that in turn
He's
is
getting the play,
making
yeah.
the movement. So it's a little,
Yeah,
It's
a
the
little
puppet. The manager of the mutual fund is a puppeteer.
Okay.
Yeah, exactly.
He or
That-
she is pulling the strings
Right,
as
right.
to how to manage that. And
Okay,
if they
but-
leave,
Just don't chase past performance. That's
No,
really the bottom
but
line
that's
here. Okay.
exactly.
Next one here, as we're discussing rules that SHM Financial suggests you follow in order to avoid potential investment mistakes. I like this one, which that's why Stan and Lee are here to explain this. Why you? All right, what do you mean?
what do you mean?
Yeah, as we look at Stan, what do you mean?
Well, you
He
know-
put this one in, folks, so
Well,
just in case you're wondering.
Why should they deal with whoever they're going to deal with? In
Okay,
other
so
words,
so why
no.
should I deal with you is what
Well,
you're
again,
saying.
it's a matter, you have to fit and you have to have the personalities to deal with whoever it is you're working with.
Right.
If you don't have the same personality, it's going to be a conflict or a disaster waiting to happen.
So in
you
other
have to be
words-
on the
yeah,
same
right.
page as the person that you're dealing with.
In other words, if I'm the client and I like the fast action of trading a lot of stocks, and that's not your philosophy,
Right, may not be my particular
it may
style.
not your
but-
particular style, and that's not what you've done over since 1958.
No,
So then you and I might not be a good fit, is what you're saying.
Well, exactly. If they're looking for that, then no, we are not that fit for that particular person. And that's what you have to go through when you interview whoever it is that you're going to deal with.
Okay, so you're saying that the person is saying to themselves why you, the advisor, or the advisor is saying why you as a
Both.
client? Both.
But
Okay.
we're interviewing them, they're interviewing us.
Right.
And if
You're,
we
you're
come,
trying to get a fit.
Exactly. And we know going in, we do not fit everyone.
Okay. Another one here as we're moving along to try to help you avoid potential investment mistakes here on the show. Resist snob appeal. Okay? Yes, snob. Yeah, that's
It's a different code there
I know, but
for that.
It's supposed to be snob appeal, right?
That's right.
Okay. What do you mean by that?
Well, a lot of times you want to invest in those kinds of things that you hear about. the hedge funds, the supposed geniuses in the world that have had mediocre performance,
Right.
but that's another story. So you look, well, the hedge funds are, or this super person who you hear all about all the time, the Warren Buffetts and
Donald Trump?
these kinds of people say, well, I want to follow what they do. Well, that makes no sense, because you're only finding out what they've done after they've done it, not as they're doing it, where you could participate in that way. So that's what you want to try and avoid, just to be like the Joneses, so to speak. You don't want to be, you want to fit together and put together something that makes the most sense for you at this particular point in your life, and make sure that you have the exit strategy to adjust as your circumstances constantly change. So it's not...
If Trump is doing it, run the other way,
Well,
right?
that's
Okay.
another story.
Okay.
We could have 27 programs about that. Right?
More to talk about here on the show. It's Molotsky on Money. We are here every week at this time discussing a variety of financial issues. And we have, of course, more to talk about here on the show, talking about rules that SHM Financial suggests you follow in order to avoid potential investment mistakes. With Stan and Lee Molotsky, I'm your host, John DeMasi. More of this edition of Molotsky on Money after these words. Stay right there.
Since 1958, the SHM Financial Group has been providing sound financial insights and strategies for people just like you. Founded by Stan Molotsky, the SHM Financial Group believes in safety, security, and preservation of principal. For more information on how the SHM Financial Group can help you, contact them at 1-800-MONEY-SHM. That's 1-800-666-3974, or visit them at shmfinancial.com. Call us to discuss the reverse mortgage concept. If you should decide to proceed, you're required to go through a 60-minute phone or office interview. We will provide you with a list of HUD counselors you can call who will provide you with the counseling. Call us at 1-855-HUD-REVERSE. That's 1-855-483-7383.
Welcome back to Molotsky on Money. Don't forget, if you would like to contact Stan or Lee Molotsky at the SHM Financial Group, we have the number on the screen from time to time. Probably a good idea for you to write it down. So later on, if you want to give them a call, feel free to do that. Ask them a question. If you'd like to meet with them, feel free to do that as well. Remember, the initial consultation is complimentary. Also, we have their email address and their website as well. You can contact them either of those ways. Tonight we're talking about rules that SHM Financial suggests you follow in order to avoid potential investment mistakes. We want to try to get to them all before we leave you tonight, so let's get right back into it here on the show. Our next one is, it's not just about risk and reward. Let's have Lee get in here and explain to us what we mean by that.
Well,
Lee?
actually, I think it has a lot to do with risk and reward. The basis of our discussions normally starts with how much risk, if any, are you comfortable in taking with the deposit that you're about to make? And I would begin the discussion by having that part of the addressed. But really, the essence of what we do is really what is this money for? What's important about this asset to you? What are your goals and objectives with this deposit? First.
Yeah, it's not just about the risk and reward, right?
It's like
It's
Lee just
other
said.
things,
That's
right?
the key, like Lee just said. It's first, there's a multitude of other things, and it constantly changes. Plus, that's why it's critical that we meet with both husband and wife, assuming they're married, because his risk reward may be different than hers and vice versa. And our job is to blend it together to make sure it's going in the same direction.
Okay, we want to try to get all these in before we leave you tonight. Our next one, when we're talking about rules that SHM Financial suggests you follow in order to avoid potential mistakes, you've said this hundreds of times, Stan, on the radio show, and you've said it here. Know how your advisor gets paid. Why is that important?
Well, there's no right or wrong in how the advisor gets paid. The critical thing is for the person to know how they get paid. Do they get paid a commission every time there's a transaction? Nothing wrong with that, as long as you know that. We have a fee-based investment advisory division that charges a fee to help the client manage those money, and that's how we get paid in that particular division. So it's just a matter of knowing up front exactly how whoever it is they're dealing with does get compensated.
And that's important.
Well, just for peace
because
of mind,
just
so that
you'll
there's
know.
no surprises.
Okay.
And, right.
Okay. All right. Again, we're trying to give you all of these before we leave you tonight. The next one is know who the custodian is of your assets. Lee, would you explain to us what is a custodian?
Yeah, sure. In simplistic terms, the custodian is the institution or entity that actually holds your money, in simple terms.
Okay.
They hold your money. We, as a registered investment advisory firm, the Molotsky Tax Advisory Group, which is a fee-based registered investment advisory entity, hold our assets at an institution.
You don't hold any of the money?
No.
Okay.
No, we do
All
not.
right. So if I invest with you, I give you a check for
You
X
don't
amount of
actually
dollars.
give me a check.
or
us a check.
I don't give it to you. It goes to
Well,
the.
you give it to us,
But
and we
you
overnight it to-
you overnight it to them, so you don't hold any of the money. You're the advisor. You're helping to
we then
make these
act
investments
as
work.
the overseer and massager of the funds.
You're the quarterback of the team.
We are the quarterback of
All
the
right.
team. You own the team.
Right.
We are the quarterback,
Okay.
and we will play by.
And it's important that that person has access to those accounts by computerization. In other words, you click on and you can see your account 24 hours a day, 7 days a week under the advisory entity that we utilize.
Right, so
And
there's no
that's critical.
surprises.
No surprise.
2 o'clock in the morning, I can't sleep. I can look at my investments, see how they're doing.
Exactly, and the money goes to the custodian, and it comes from the custodian, and it's direct, and it's not at our entity.
Okay, we have one question here that we want to get to because we think it kind of fits in to the show's theme tonight. We do have these from time to time here on the show. An email question from Dan in Mount Laurel, New Jersey. He says, I've been following your shows for years and I like what you have to say. I recently met with an advisor who I decided not to go with after 2 meetings. He kept pushing my wife and I into a specific variable annuity. I thought that was rather odd, seeing as how we said we were very conservative and didn't like anything that was variable. My instinct told me that he was most likely getting a large commission if we went with that investment. What do you think?
Well, again, let's hope that's not the case. Let's hope that that person was making the suggestion based on what they had told him. But you know, a variable annuity is different from a fixed annuity.
Right.
Even if that would be something that they might possibly want to consider. Fixed is guaranteed with no loss of principal. Variable is variable. It can vary based on the package of things that the person puts the money into. So if they were looking for no risk, and there are certain no risk variable annuities that can do that, but the fees to some of those are substantially larger than what they really, we feel, should be. So
Let me ask you this. If an advisor is pushing a client into one thing, is that something you should worry about?
again, it comes down to knowing how your advisor gets compensated.
Okay.
And you know, we don't have a product line at our entity. Our job is to meet with the client, go through the goals, objectives, risk tolerance, what they're trying to do with the money, their health, a multitude of different things, and come back based on the entire universe of different things that we can suggest to the client.
And with that, we're going to put the wraps on another edition of Molotsky on Money. Don't forget, you can contact Stan or Lee at any of the ways that we suggested earlier. For Stan and Lee Molotsky, I'm your host, John DeMasi. Always a pleasure. Thanks for watching. Good night, Alexa. Good night, Jenna. Talk to you next time here on Molotsky on Money. Take care.
Do you know what your risk tolerance is when it comes to your investments? Do you know exactly what you have in your portfolio? The SHM Financial Group have developed a very important program called the Financial Stress Test. It's simple, quick, and can help you in your future financial plans. Contact the SHM Financial Group to schedule it. Offices in Collingswood, Voorhees, and Lakehurst, New Jersey. Call 1-866-MOLOTSKY, 1-866-665-6875.
Throughout our working years, we accumulate as many retirement nest eggs as possible. The problem is, not much attention is given to the color of the eggs. Do you know how much of your assets should be allocated to each color? At our firm, we have a system that helps you allocate your retirement nest eggs correctly. We have a simple way for you to group your retirement assets into red, yellow, and green money. Give us a call today and we will help you sort and label your retirement nest eggs, giving you a clear picture of the color of your retirement.